All right, good morning, everybody. We have a couple of Fed speakers today. The main thing looks like services. It's something that they use in a dot plot on their FOMC decisions. It's a really big deal. It's one of the last few bubbles that still need to pop, and I believe is a little more impactful probably than the non-farm payrolls. But that's a pretty controversial statement to make. I don't necessarily, say that is a dichotomy that I would lean on constantly. But in the current space, I'm really more concerned about the manufacturing data and the services PMI than I am about the payrolls this week. I wouldn't always say that, which really just means we need to keep our eye on the clock, not just at 8:30 this morning, but later this morning, 10 o'clock. 10 o'clock is going to be a real big one. The additional Fed speakers, we got one at 2:30. Whenever we have a Fed speaker, we want to know, hey, is it pre-recorded? Is he at, some Girl Scout luncheon, or is this going to be, like a big forum event where there's questions? Because it'll have a lot to do with whether or not he could impact the market, right? If he's just going to stub his toe and put his foot in his mouth, then, we want to know that that's on the table. If it's a pre-recorded message with no questions and it's at some really low-level public event, then it very likely won't have any impact on the market. Don't get me wrong, though, the non-farm payrolls have the capacity to be impactful. Okay, so 8:30 has its own set of fireworks, but I would continue to monitor the clock, because when we come into 10 a.m., that could be a whole other can of worms. It does appear that crude and Brent are going to find some support along this angled trend line. Whether or not that support holds is a completely different thing. This could be just a minor pause before a continuation lower, but both of those markets are in an inside candle now. Okay, so how we come out of this very large candle from February 2 is going to be the big deal, right? And that's yesterday. If we get an inside day breakout to the downside and continuation below that trend line, or if we stabilize, we get another day, say an IX10, or if we actually reverse and break back up. If we do break back up above that Feb 2, it's very likely just a rally into resistance, right? A small short-term movement off of support before the continuation lower. We're certainly not going to expect to see crude and Brent retest this previous pivot point. Of course, anything is possible. The Asian markets closed down on the day and on an inside day breakout, but they did manage to stay inside this larger range from the 31st of January. Europe is still open. It's around 12:30 there right now. And we are just getting into an inside day breakout at that point. A nice continuation bullish move from February 1 into the 2nd and now into the 3rd. We can see that it's not really carrying over into the US. The Dow closed down yesterday. Again, it's that dichotomy that we talked about in yesterday's morning briefing, how these indexes represent different sectors, different industries, different companies. And the Dow is your blue chip mega market, legacy, what I like to call legacy names, right? The old school household names that everybody knows: GE, GM, McDonald's, Visa, Boeing. You may not know the symbols for those names, but they're certainly household names. They're down. And what is doing good are the other kind of names that are addicted to borrowing, that like to see a lower dollar, that would actually benefit from a lower dollar. And in large part, that's tech. Tech is absolutely addicted to borrowing money, like junkies. The rig count today at 1 o'clock, I worked on those rigs for 20 years, and most of the time you're not going to see a significant difference between the number of rigs that are running this week and the number of rigs that were running last week. That's not to say that we couldn't have some shenanigans and something surprising pop up. Obviously, anything like that is absolutely possible, but on a day-to-day, week-to-week basis, this number most of the time will have no impact. None on what's going on in the market on a day-to-day basis. We got a new high yesterday, giving us a new higher high for the first time since August of last year. So when we had that rally off of the June lows, and we managed to get past this May pivot point, we had set a new high, and we ran into the 200-day moving average and then took that rejection. Since then, we really haven't had one that would even count, and we can't necessarily count it yet because we didn't close higher than the level yet. I was going to count this one a while back, but we had faded back out of it, so we wicked up through and higher than that level, and then dumped back down. So we're there today. We need to close higher than, and we will have a higher high. We need 2 higher highs and 2 higher lows to have a full set. And once we have a full set, we have a confirmed trend. Now, trends can end, and the legs that we use, or the price swings that we use, can be whatever you want. Depends on the time frame that you want to use. So if we were using smaller, say like OCR style analysis, we could focus on, say, something like that: higher high, higher low, higher high, and higher low. We could. I tend to try to use something a little bit bigger in those price swings. What I just used right there is a linear regression line. You can find it on your drawing tools. And there's our swings. So this needs to complete. It gapped up and fell down this morning. Oh, wrong one. So the volume is within range. 116 area is just fine. That's cumulative volume from the overnight hours. That's all we need to see, is that it's okay. It's in range. Turn that off. We have a narrow initial balance, an IB. This usually implies that there is potential for work to be done, or that potentially the work for the day has not yet been completed. Kind of see it however you want. We didn't really get a big move through the kill zone, and right now we are still sitting inside of the cash session from yesterday, but just barely. That it lines up with our Globex low. So when you're marking out your open, high, low, and close, keep your eye on which high. Is that the Globex high or the intraday high? And which low? Is that the Globex low or the RTH low? So right now we're kind of testing and flirting with the RTH low of yesterday. We've crossed through the daily pivot a few times, and we have not yet tested that high from yesterday. And so far, I mean, the way it's looking, we might not. The thing is, we have some really big econ on deck today. Although I kind of jumped over it a little bit, the 830 econ today has the potential to get a little violent. So we very well could see, you know, a nice giant spike in the pre-market here. Just keep in mind, if we do see that, it's a liquidity vacuum. Sure, you're going to see a candle there. You're going to see that there is no gap. Well, we call it a gap. It's a liquidity gap. And very often those liquidity gaps get filled. The last one that we had was December 13th, I believe. So if you were to go back to the December 13th, you'd see in the pre-market this really beautiful expansive candle. And then how we spent the rest of the morning nearly into lunch coming back down and getting that gap closed before we did anything else. And it's not a one-time thing. We did it in November. We did it again in October. We did it in September. January's was reset nearly immediately within, say, an hour, I believe. Quote me on that. So here we are again. It may be how we wrap things up. 10-day, 30-minute volume profile, 39.20 on the low end. I mentioned that we were going to lose this lower volume this morning if we had not come back down here after FOMC. And that's exactly where we're at. So through the day today, the last of this volume down here is going to be gone. And then our new low will be 39.60. We've still got, you know, a relatively steep lower trend line. You know, just kind of maybe we ignore some of those wicks from FOMC, tighten it up more into the body. We're coming across into it. We also have this very ugly head and shoulders. Now you got to kind of squint at it a little bit, maybe close one eye, turn your head sideways. If that is going to be our head and shoulders, then the neckline break 4160, we can plot the measured move. 4100 would be a little more than 50%, and it would tie up into this pivot point from the 27th. And then 100% of that move should put us around 4060, maybe 4065, something like that. It's an actual head and shoulders in an area where it belongs, right? You know, in the last week or two, we've seen inverse head and shoulders at the highs, and we've seen regular head and shoulders at the lows, and that's not where they belong, right? We don't trade those. All right, VPOCs over our head. We got one yesterday. 5-day, 5-minute volume profile. So now we've got one on each side. Very likely when we make a move into that VPOC, we get at least one rejection, first touch rejection. Very often that can be day done trade right there. Otherwise, the question for today is, can we keep all of this? All right, that's going to be the biggest takeaway. 4140 on the low end and 4210 on the high end. Can we keep it? And so far, yeah. So far, we're keeping it. But if we do break below this 4135, 3140, whatever this low down here, we're going to move through the rest of that very fast and get to the VPOC quickly, because there's nothing here, right? It's an air pocket of risk. We'll drop right down through that area very quickly, just like we moved up through that area very quickly with little resistance. So we come back over here again, 10-day, 30-minute volume profile. You can see the profile, right? We got some trash that we're kind of hanging out in. If we break that low, it's a shallow area. There's nothing there. And even this pivot point from, the 27th, there's nothing there. So we're very likely going to move through all of that really quick and get at least snuggled down into this volume here, starting at around 4,100 and lower, down to the point of control at 40.35. I didn't mention it when we were here a few minutes ago, but when we're at the low, we expect to go to the highs. And when we're at the highs, we expect to go to the lows. This is what we do. Next week's expected move is already on the chart. It's not set in stone yet, right? This indicator is still alive at the moment. We want a locked expected move, and right now it's not locked. It won't lock until after the close today. The gray line is the current price. As the current price moves up and down, all of these lines here are going to move up and down with it and expand and contract with the amount of volatility that's being registered within it. At the close, it'll lock into place, just like all of these previous weeks that are on the chart. Each one of these weeks, these lines were drawn on that Friday, and then they were locked into place on that Friday. In normal market conditions, price closes with inside the box at least 80% of the time. That's an impressive number, 80% or better. But when things aren't going well, we start hitting that other 20% more frequently. What I like to do for this easy number percentage, just to, and it's like a napkin math kind of thing, is I just count back 10 weeks. And I asked a very simple question. In the last 10 weeks, how many times did we close at the end of the week outside of this box? And whatever number you get, say we closed outside of the box 3. Well, that's 3 out of 10. That's 30%. So it's supposed to be 80%. If we're doing 70%, then we're slipping a little bit. But if you count back 10 weeks and you've closed outside of the box 4 times, 5 times, then it really highlights how market makers are getting it wrong. They either the size of the box is wrong, or there's just so much violence and volatility that we're not staying in the box for whatever reason. But it can often be a heads up on what kind of options play I want to use. Because, when we're running probability-based options trades, things that lean heavily on the statistics and less on the TA, the technical analysis, then the statistics need to be on my side. And if we're closing out of the box more than not, then the statistics are not on my side. I have to take the other side of the statistic. So something to consider. We are outside of the box right now for the current week. And the question becomes, are we going to close inside of this box this week? Will price drop back down through the morning session today and we close inside of the box? Or on the line, like we did last week, that would have been a butterfly event. Or here, that would have been a butterfly event. That's why we use those lines for our weekly butterflies. While we're here, I always like to take a look at what next week's box is projecting. You can just take this week's box and set it over next week's lines, and you can see how they've got more volatility priced in at this point. Throughout the day today, that red line could certainly come up and get a lot closer, right? Or I should say, together, the green would come down, the red would come up. So it could contract through the day today. But at the moment, we are projected to see higher volatility next week than this week. What could be more volatility than what we already just had? Apple, Amazon, FOMC. What is on the table next week? We're 1.9% above the 10-day moving average. That's usually, a good spot to see a pause. Not necessarily a reversal. It doesn't owe us a move back, but certainly a pause in the advancement. And like we've talked about before, we've gone higher than this level before. No big deal. But it usually doesn't stick much more, right? Maybe 2 or 3 days and then we come back in again. But 2 or 3 days can be a lifetime when we're talking about, trading. The main thing is we're not in overbought territory, as much as I don't like that phrase. It's the one most commonly understood. So have we moved too far, too fast? No, not yet. We're certainly in that neighborhood. Same thing for the 10-week. We're 4% above the 10-week. We've been higher than that. We can see back in August when we were running up into that 200-day moving average. It didn't stick. We came back off of it within a few days. But when we're looking at it on the weekly, we're overbought. We've moved pretty fast, and we have an expectation that now we're going to pause. If we think about that capital rotation that's going on, tech is suddenly doing good, finance, consumer discretionary, even a little bit of industrials. But building materials flattened out, energy's taking it on the chin. Healthcare, the trend is down. Consumer spending in the household, staples, down. So, we're a little bit of capital rotation here. The idea is the follow through. It really looks like technology and consumer discretionary are getting a bit ahead of their skis. Really big gap up yesterday. Not only was it a big gap up, it kept it and moved farther away and did not close the gap. It's a pretty bullish thing to gap up and not close the gap and continue to move farther away from the gap close. Right, like we had that gap up here. We continued to expand farther away from it. It's still not a gap that's closed yet, and it just kept on going. So the main takeaway is if we break below 41.36-ish, right? If we break this low from February 1, we're very likely going to go down to at least 40.80 and come down to the open from Wednesday, at least. Because that would be an air pocket of risk, and we're very likely to get it closed, right? Get that gap closed. So that's the negative side. Let's kind of flip it over and talk about, well, what if things continue to be bullish? Because, we've seen that yesterday, how even though we went parabolic and kind of got into some nosebleed areas of the stadium, and then it dumped down, it came right back up again. So no matter what the econ looks like today, we could still go up. We talked about the downside just because it seems like the most obvious direction that the market's going to go at this point. But markets can do whatever they want, even though we say it's not very likely. And if you've watched my morning briefings enough, you've probably heard me say things like the least likely scenario is, and then that happens to be the thing that we do the day, right? And I say, nah, I'll mention it, but I really don't think it's going to happen, and it'll be that thing. So the topside breakout, 4208. If we expand beyond that today, we're going to very likely squeeze those bears that started their trade yesterday to short this thing. And the last ones in will be the first ones out. They're going to have to buy back to close. That'll add to the buying. It'll just fuel the more buying, which will push us even higher. We're barely outside of the weekly expected move, so the algos won't buy into this buying because we're not like at a 2 standard deviation distance yet. So we don't really have to worry about those necessarily. Just all of the people that we're going to be squeezing from yesterday if we happen to get that breakout. So the ADR half is 4208. It's also yesterday's high. The full ADR is 4241, and we can add more than 0.75% above that because we have a market maker move today. $42.75. Nice round number. Not too bad. That would still keep us below the August high, which is around 43.30-ish. But it would certainly resolve this high from December 13, which, remember, that is the day that I mentioned if you want to see a pre-market mover. December 13 is one of the FOMC, PPI, CPI, one of those days. Big econ. Otherwise, we do have a bit of a very narrow, very squished rising wedge here on the daily. And a rising wedge breaks to the downside. It doesn't matter that it broke out of the top first. It's usually a fake out, like a blow off top and a rising wedge. And then after tricking everybody, it ends up dumping down through the bottom. If that's the case, we're going to be looking at 4,000 and then 3,900 for our levels to the downside. Obviously not in one day, right? We're just talking about this rollover here from the rising wedge breaking through the top. It would still have to roll over, get back into the old wedge, and then get out of the bottom of that wedge, and then make the move in the measured move. If you look at the NASDAQ, it really seems like the bottom is in, right? We have an old school classic double bottom and then a retest. Makes it nearly a triple bottom. We've certainly got a solid base built. between now and the next year, it really looks like third quarter, maybe fourth quarter, we start getting into the Fed pivot, or at least the Fed pause, right? Not pivot, not cutting rates, but at least not raising them anymore. We've seen some significant moves in the last few days in the yield curve. It really looks like the entire market has kind of turned that corner, but there's a lot to change, right? There's a lot to go through before we just come back out of all of this mess again. We still need to see a significant change in where the money is going. What we're looking at here is the Dow. And after looking at the S&P and the NASDAQ, it should stand out on how absolutely different this index looks. You know, often on a day-to-day basis, we look at the Russell, the Dow, the IWM, the RUT, the DIA, the YM, QQQ, SPY, ES, NQ. And we kind of lump all these indexes together because generally speaking, they rise as a group. They go down as a group. The rising tide theory. That's not playing out right now. That's not the way things are working out right now. So here are the small caps. That's looking pretty solid. Remember how the Russell sat out through most of that year? 2021. It really early started this recovery compared to everything else. So when you're looking around at the names that are out there, keep in mind that when we come out of markets like this, these bear markets, old leaders very often are not the new leaders. It really seems like the monsters of tech are going to dominate again. So far, that argument would hold true. But it's only been a day. So we got to kind of let things play out a little bit. We'll know more by the end of the weekend because I'm sure someone's going to do a full Ginsburg and hit all the talking shows over the weekend and kind of give some guidance. We want to see how all these Fed speakers start talking. Are they all on the same page? Are they all speaking out of the same book? Are they all pushing the same message? And what is that message going to be? It's something that you're going to want to be looking for this weekend when you're checking out news. Cloud, communications, semiconductors, Bitcoin, those are down a lot. Less we start getting into expanded tech, the China ADRs. For things that are up, gold, natural gas, bonds, slightly. A little bit of healthcare and a little bit of energy, but they're so minor that my benchmark in the pre-market is 0.5%. So anything less than that, and I don't consider it up or down yet. If we're using that benchmark and we're sticking with it, then nat gas is the only one of those that I named that is actually up this morning. that doesn't inspire much, right? That's still looks like it's trying to build a base down here. It's not built yet. I wouldn't trust it. It's not even rounded yet, right? All we did is lift off of the lows a little bit. This is by no means a reversal yet. And when that reversal does start to kick in, there's a long ways to go. So don't feel like you have to jump in. I did get in. I'm already in. I'm long. But it's a longer term trade, and it's a really cheap trade. If I'm wrong, I'm going to lose like 3 pennies. No, it'll be okay. I'm not losing sleep. But I'm looking to add in and build out this position more once it actually does turn, prove its stability, and begin working its way back up. We just don't have that yet. It's a really big gap up that we have in the Qs and in the S&P. If you look back at previous really big gap ups, say like back here, and another one here. All right, so you can find them. We don't always gap up and continue. A lot of times we gap up and just kind of stall out. Other times we get a 1-day gap up and then down we go. So how we open this morning is going to be worth a lot, but how we close on the week and how we open up next week will mean so much more. So I wouldn't get too excited about swing trades yet. I want to see how this week closes and how we open on Monday. It's going to be a very large part of anything else that I would want to do. And there is this old thing of a 5-bar rule. It's not my rule. It's just like a thing. You can Google it. And, we can look back and we can point to times where it went more than 5 bars and it just kept on going, kept on going. But generally speaking, 5's about right. After the 5th bar, 1, 2, 3, 4, 5, tend to stall out, flip back. And that's if you actually form the 5th bar. Here we had a nice recovery, 4 in a row, and then flip and dump. Well, this is bar 5 this week. So we need to see how the next week opens. If we gap up next week, I'm really going to consider that a short. If we gap down next week, I would hold off on any shorts because that very well could lead to another week of a rally. So just something to consider. Looks like they're front running the data this morning. We're not really getting anything this morning. It really seems like they want to wait on the jobs data and very likely the services data at 10. The MOC was light yesterday, way lighter than I expected it to be. It was within norms. Let me say it that way. It didn't come in at a low number. It just didn't come in at a high number, which was a little bit of a surprise. It would make sense that they want to get through the rest of this week, but especially the 10 a.m. services data. Services is one of the last points of contention. It's the last holdout on this whole sticky inflation thing. It ties directly into wages. So that's really what we're stuck with at this point, waiting on the Econ. Which is good enough. That at least gives us some guidance. Looks like NVIDIA is about to finish up at least 50% of that head and shoulders, inverted head and shoulders measured move. Should be anticipating a little bit of pullback somewhere around that 220. Could overshoot it into like 225. So really that's it. The rest is wait and see. Everybody enjoy your weekend. Be careful, be safe. We'll see y'all next week.